Lindsay Reiser, thank you so much. Also breaking, we've just learned that the Federal Reserve is keeping interest rate hikes on pause at a time when borrowing costs are at a 22-year high. CNBC's Morgan Brennan has the latest for us from CNBC on MSNBC. So talk about this decision and the implications.
Hi, Chris. It's good to see you. We just got this decision. The Federal Reserve leaving interest rates unchanged. This was widely expected, extending the pause at its policy meeting today. This is the second straight time that officials have opted to keep rates unchanged. Keep in mind, though, those benchmark rates still at elevated levels, up more than 5 full percentage points since the Fed began hiking in March of 2022, and rate cuts are not expected anytime soon. The Fed has been very clear in its message of higher for longer for those rates. The key today, though, and this decision was unanimous among the voting members, Fed Chair Jay Powell's comments in the press conference, which will kick off in just under a half hour. Investors will be looking for any clues about how the central bank is thinking about the future, starting with the next policy decision in December, which will be the last of 2023. Markets think the Fed is done raising rates, but officials have repeatedly said this will depend on the data. And that's really the conundrum for the Fed, and it's showing up in this release from the FOMC today as well. After the worst bout of inflation in 4 decades, it's come down, but the pace of those price increases, it's still too high. It's more than 3% higher than the Fed's 2% target. Meantime, despite the aggressive monetary cycle, most aggressive monetary cycle in a generation, the economy seems to be hanging in there. It's much more resilient than experts thought at the start of this year. Labor markets staying relatively strong. Consumers continue to spend. You saw that with third quarter GDP of 4.9%. So where does Powell and the rest of the Fed see the economy going from here, especially if the full effect of all of those previous rate increases hasn't been fully felt yet? The other factor, the bond market, the yield on the 10-year Treasury bond spiked to 5% last month. It's come off a bit since then, but that was the highest in 16 years. This is the benchmark for loans. It has made mortgages, credit card interest, other types of consumer and corporate debt much more expensive now. And because of that, Chris, is arguably going to do some of the work for the Fed, meaning cooling demand, which in turn should continue to cool inflation further. But we'll be watching for those Powell comments in just a little while.
Yeah, and I know it literally just happened, but are the markets reacting?
So far, markets are positive right now. I'm looking at a chart of the S&P 500. It's up about 0.5% right now. Dow seeing a similar move. So we're hanging on to gains after a red October, a really rough month for stocks last month.
Morgan Brennan, thank you so much. It's good to see you, my friend.